I'm Laura Diarte, Head of PR and Communications at 0100 Conferences, and I'm here with Mark Russell, Investment Director at Vencap. And he's also responsible for the secondary strategy of the firm. So, Mark, could you start by giving us a quick introduction about Vencap and the investment strategy?
Sure. No, great to be here. Bit of background on Vencap. We've been investing in VC funds since 1987, so coming up to 4 decades now. All we do is VC. We've invested about $3 billion into around 500 individual venture funds through primaries and secondaries. I think the key learning from that experience is that this is a power law asset class. It's not like private equity. The majority of VC-backed companies fail to return capital, and the top 1% of companies drive the majority of return back to the asset class. So it's all about getting access to those top 1% companies with meaningful ownership if you want to generate the outstanding returns that venture can offer. We express that in 2 ways. Through our primary strategy, we back those managers who consistently access those top 1% companies with meaningful ownership. That generates fund returners for them. On the secondary side, it's a natural extension of our primary strategy. It's an opportunity to gain additional exposure to those clear top 1% companies at attractive pricing versus fair market value, with the additional benefit of much shorter duration on a cash flow basis.
Wonderful. And you are responsible for the company's secondary strategy. Can you please explain us a little bit? What are VC secondaries and what are the specifics of VC secondaries, right? Because we have seen secondaries have been thriving lately, but mostly when we talk about private equity, right? So what will be the difference?
Sure. Yeah, I mean, it's a much more nascent market compared to private equity. So as I think about VC secondaries, what are they? It's an opportunity to get exposure to VC-backed companies through secondary transactions. Those secondary transactions can take the form of buying positions in VC funds in the secondary market, participating in GP-led continuation vehicles. That's a rapidly growing segment of the VC market, or buying stakes in VC companies directly. We very much focus on the first two, buying fund positions and looking at GP-led deals. Many VC managers themselves pursue direct secondaries in their high conviction companies. It's equivalent to the sponsor-to-sponsor secondary market that you've got in private equity. If we are approached by a venture firm that is looking for additional capital to pursue a secondary transaction, we would happily look at that and support them in doing so.
And since you do primaries and secondaries, now what can you say are the benefits of secondaries compared to primaries?
Yeah, so I think given how value accrues in a venture fund, I think the benefit of secondaries is that the portfolio will be fully invested and it will typically be weighted towards the winners that have emerged in that fund. So you have the benefit of knowing what you're buying. And then there's the attractive pricing versus fair market value, which we think is an important distinction from NAV. And the cash flow duration is much shorter compared to primary investing. So you're getting later stage VC-backed company exposure, attractive pricing, shorter duration.
How large is the VC secondary market?
So it's a function of the primary market. There's about $3 trillion of unrealized value globally in venture funds. And then the secondary market is how much of that sort of changes hands each year in terms of ownership. In 2024, there was about 16 billion or so of VC fund and GP-led deals that closed, about 10% of the overall secondary market. So you can see that it's a kind of a 0.5% annual adoption of secondaries within the VC market. For comparison, private equity is like 4 trillion, and it was over 70% of the secondary market last year. So you can see much more mature market that's approaching kind of 3% in terms of secondary adoption. And that adoption is a function of market awareness and adoption and need for liquidity. And as we know, organic exits have slowed, which has meant that LPs in venture funds have looked to generate liquidity increasingly through the secondary market. The direct secondary market is much harder to size. If you just look at the sheer size of some of the very large company-led tender offers that happen in the market, it's clear that that's many multiples the size of the LP, GP-led VC secondary market. For us, we're already inundated with attractive deal flow on the fund and GP-led side. That's enough for us to focus on.
What drives this deal flow in the VC funds and GP-led secondary?
Yeah, so again, it's back to that adoption point. It's secondary market awareness amongst LPs and GPs. I think it's become more of a portfolio management tool than it was in the past. We're seeing more use of GP-led structures in the VC market, particularly coming out of the US. I think like we saw on the private equity side, once many of the blue chip firms had completed these deals, that signaled to the rest of the market that there was somewhat of a stamp of approval to proceed with those types of deals. So we're seeing more and more of that. We're looking at two sort of fairly high profile ones in Europe right now.
Wonderful. What's the typical NAV for VC secondaries?
Yeah, it's an interesting one, thinking about fair market value versus NAV. You're buying exposure to companies for a certain price. And so your cash on cash return in the end will be a function of how good your entry price was and how good quality the company exposure was. We've seen over the long term that optimizing for quality is what delivers on a realized basis. We're not interested in buying mediocre assets at large optical returns. I think the nuance comes from two key things. One is the use of last round value for venture valuations in funds. That's extremely lagging, which can be a real opportunity or a risk for the buyer, depending on how the company has performed since that round was done. We also see a huge amount of variation in valuation policy between managers for the same company. Some managers are much more conservative and so may not necessarily have written their company up fully to that last round value, and they may have proactively written the company down after that, which means for us, we can often get better look-through entry pricing on a more conservative fund at a smaller discount than we would on another fund at a much larger discount. So you need to be able to look through and have the information to do that real company underwriting.
And finally, what is your outlook for 2025?
Yeah, we're really excited about the secondary opportunity. Looking at our own deal flow statistics for this year to date, Q1 was up 40% year on year in terms of deal volume. We typically find that about a quarter of the transactions by number, we have a clear Vencap angle on. They're the ones we want to spend our time on. We say no to a lot of things very quickly. Live pipeline now is extremely full. Key thing holding us back is capital availability. We see number of deals right now where we've got a great angle on, really attractive, but we just don't have the dry powder to execute on all of those opportunities.